whether it's for the financial statements or the actuaries. These are the actuaries' numbers. So just to be clear. So depending on how you look at the unfunded liability, if we look at it on a market value basis, we're about $600 million short of where we'd like to be. If we look at it on the actuarial basis, we're about $1 billion short. And so in either case, on a market value basis, we're 88% funded. Actuarial basis, about 80% funded. Those are both actually pretty good numbers for public pensions. And that's great. That's because the plan's been well managed. Obviously, we'd like to get to 100. And so that's part of a longer term plan that we put in place. And we had the board approve a policy, which we'll talk about. So the next slide. So it's just a visual. I kind of like this. I mean, this is a projection of the amount of benefit payments that will go out the door. And it actually, this only goes to 2080, but it carries on another 30 years. It just got so small in the graph. So one of the interesting things is that even though the plan is now closed to new participants, the amount of benefit payments that we will make will continue to grow over the next 2 decades. And just to put into perspective, if you look, probably over on the left-hand side, you'll see far left, you'll see UMKC operating budget, roughly $400 million. So just for comparison, relative comparison, our benefit payments going out the door, even right now, roughly equal the entire operating budget of UMKC. So that's the magnitude of this benefit, this liability for the university. And it's why it has to be carefully managed, because ultimately, back to that first slide, that contribution number is the only thing to make up for the other two.
So, as far as the contribution is concerned, we as retirees don't contribute to this plan anymore, but there are quite a number of active employees that are still under this plan that still contribute to it. That's correct?
Yes, that's correct.
Okay.
I think on the next slide, so this will get into the point that you just raised, but it's also an issue. So yes, I'm an active member of the defined benefit plan. My wife is as well. We pay a percentage of our salary in. All active employees that are in the plan do. So one of the things that's going on, and again, why it's important that we carefully manage this, is the mix of employees at the university is shifting. The graph that you're seeing in front of you, the bottom part, the dark blue part, is called level 1. So those are people probably like all of us in this room that are in the traditional defined benefit plan with 100% DC benefit. So that's slowly creeping down. The lighter blue color up above is level 2. So those are people that are in the hybrid plan that started in 2012, and that was closed out in 2019. And the top bars in the white part of the bars, those are the new people now that are in the 100% DC plan going forward. And with the turnover at the university, which is not new, the number of people in that defined contribution plan will quickly grow and surpass the amount of all the rest of us in the defined benefit plan in a matter of maybe 6 or 7 years. So what that means then is that the contributions that the employees are putting in, those are going to slowly go down because the number of employees active in the plan are shrinking, which then means it's the university at the end of the day. The university has to make those benefit payments. So if there's not enough money in the trust, and again, there is, we're in great shape, but ultimately the university has to pick up that difference. So that's again, why it's really important for the university to manage this very carefully. Next slide. So these are things that most of you are aware of because you may have been active during some of this. Back during the financial crisis, when Gary Ftse was president, we added in the employee contribution requirement. That's when it started. It started around 2009. And off the top of my head, I think employees pay 1% of their pay up to $50,000 and 2% above 50,000 up to a cap. So that was initiated in 2009. That amount of the contribution has not changed. That requirement has not changed. We also started a benefit stabilization reserve at that time as well. That balance is now a little bit over $100 million, and that's part of our plan. 2012, and that's when the hybrid plan was introduced. So the defined benefit that employees received was cut in half, and the other half was a defined contribution. 2019, again, we closed the defined benefit plan entirely to new employees, and new employees are in the defined contribution plan going forward, which, by the way, I just would say, because I was a part of all this, all these steps, the defined contribution plan that we have right now, well, it doesn't have some of the things, the attributes about defined benefit that we like. It's a very competitive, it's a very rich plan. When employees start today, they default an 8% withholding from their paycheck, and the university matches 8%. So new employees through the partnership with the university are saving 16% of their pay for retirement. The other benefit that we found, which was based on employee feedback, turnover is just much more a part of life now than it was before. And so employees that aren't with the university for very long or don't plan to be value the defined contribution plan much more because they perceive they can take it with them. So it wasn't just about the economics of the plan, it was also responding to what newer employees starting out, younger employees starting out wanted. So 2022, this year comes along, and we took this policy to the board, which I'll talk about. And again, it had to do with the recognition that the plan's now closed to new employees, and we need to be particularly careful about managing it going forward because it's a big liability, and we're going to make the payments. This last point, I just thrown on here, this is just so we want retirees to be aware of this, but also aware that there's absolutely no impact to retirees. We have, now this is off the top of my head, but I'm just trying to remember. We have, let's say, roughly 3,500, I think that's right, members in the plan who are terminated, so not retired, but terminated, but vested. So at some point during their career, they were here long enough to be vested in the plan, but they left the university and they still have a balance in the plan. Maybe the number was 2,500. The liability piece of all those people added together is somewhere around $350 million. So for a lot of reasons, even one of which is administrative, we're very likely later this year going to at least talk about, if not initiate, a plan to communicate with those employees and to figure out if there are ways that we can encourage them to take their money, which they're legally entitled to, and leave the plan. So basically, an opportunity, they can take their balance and they can roll it over into an IRA that's in their own name. We're just trying to get them out of the plan because, again, they're really no longer associated with the university. That has no impact on active members. It has no impact on retirees, and it's only targeting terminated people that have left. The other thing, just to mention, I mentioned since the employee contribution was put in place, it has not increased. One of the things that we were asked to do just this past year was to look at possibly increasing that contribution rate for active employees. And I think there was, the leadership was very thoughtful about that in terms of not wanting to burden current employees with more of a cost when other benefit costs were going up as well. And then at the end of the day, back to that slide where we're showing that those numbers are just going down, it would not have contributed a lot of money into the plan. So it would have had a high cost for current employees, and it really wouldn't have made a big difference. And so a decision was made just not to touch employee contributions. We're instead going to solve it just through the university. So next slide. So this is just kind of a summary of the policy that the board approved. I think it was at the April meeting. So the first bullet point, the policy basically establishes a framework to de-risk the plan over time. And I could spend an hour on that, but at the end of the day, if you think about, as time goes on, the source of the source of cash to pay benefits is increasingly going to come from investment income, from the investments in the trust. So we need to plan on beginning to make that investment portfolio less risky over time. Because the more risk that you're taking, the more volatility that you have, and the more volatility you have in your income. And that's something that becomes very difficult to manage. I said a parallel is, and particularly since we're talking to retirees, I mean, imagine that the retirement plan has entered retirement. So the retirement plan is now preparing for retirement. It's no longer active and it's getting up there in years, and you want more stability in the income that's being generated for its own retirement. So it follows the same logic where over time, we want to be able to bring that risk level down, because as the plan is sort of in retirement, we don't want to take as much risk as we did before. So one of the things that the policy did, which to be honest, just really escaped most people, because I guess it's complicated. I wrote the language, but with this policy in place, the university will actually be putting in more money to the plan than would have happened had the policy not been in place. And what the key is, and we borrowed this from the state of Indiana, which is a very well-managed plan, our contributions, because of investment returns really starting in the financial crisis, the contributions had ramped up to a fairly high level. And what the policy really says is that until the plan is really, really fully funded, those contribution levels are not going to be allowed to drop. So they would drop, they would ebb and flow over time, just following actuarial guidance. And we could actually see those starting to come down because of the investment returns in the past couple of years. And so what the policy says is, even if the actuaries say you can lower the contribution, by board policy now, we are not going to lower the contribution until the plan is fully funded at the right discount rate. So the policy, and again, there was not a lot of focus on this, but the board policy now, the board is putting in more money than they are actually required to do. That's key. So the third one,
when you say the board puts the money, that's the university contribution part of that.
right.
To make it whole.
Yeah, not the employees, the university. So then we're trying to manage costs. We're trying to stabilize the cost of the operating budget. And again, why is that? It's just more of a practical issue that we don't want the pension cost varying widely from year to year, because departments, schools, colleges, they have to budget, and benefit costs are a big part of the budget, and you want to have as much stability as you can in there. The item that got the most attention, and I'm happy to answer questions on, the policy also made clear that the plan would not pay out any additional benefits over what had already been in effect and promised as of the date the policy was adopted. So for retirees, even though the university has been pretty clear over the past more than a decade that there would be no more ad hoc COLA adjustments, this was put into policy in the collected rules. And there's a lot of discussion about that. I understand it. What's the reason for that? Well, it goes back to one of the very first slides. On an actuarial basis, the unfunded liability is $1 billion. So until we can completely dig out of the hole and be fully funded in the right way, we can't be giving additional benefits out to anyone. Everyone is getting the benefit that they were promised and they were guaranteed. Those are being paid. But what we're saying is that we can't voluntarily give out more benefits to people. And then it also raises lots of other issues, generational equity, et cetera. So that was just codified into policy. And why, the last bullet point, which is actually an objective of the policy, is to provide full transparency. We want to be very transparent about this and be very clear so that employees, retirees, people preparing for retirement, they know exactly what to expect, because that's the right thing to do. Next slide. So why is there more risk? And things are starting to turn around a little bit, I'll talk about. But if you look at the slide, the dotted line that you see kind of midway through, that's the return assumption of the pension plan. So that's what the actuaries are saying that they think we can earn on our investment portfolio. And if you look back to the time of maybe the early to mid 90s, the dotted line and the blue line again is a 10-year treasury. So think of that as a risk-free rate. They were pretty close together. So imagine in 94, 95, we could almost meet that return assumption by being invested in treasuries. So no investment risk at all. Well, what happened was since then, through the dot-com bust, through 9/11, through the financial crisis, interest rates or the risk-free rate on investments has continued to go down. But pension return assumptions in the public pension world have stayed flat. So your risk-free investment opportunity continues to go down and the gap to what you're supposed to return increases. So that means, and this applies to all public pension plans, over the last 20 years, public pension plans have been taking a lot more risk. And with a lot more risk comes a lot more volatility. And if you're not managing the volatility, then you've got issues with funding. So that's what's been kind of going on now with things in the market, which I'll talk about. We're seeing a little bit of a reversal, which I think will be a good thing. Next slide. So the other thing we did at the board meeting in April, along with the policy, is we did a complete review of all the actuarial assumptions used for the plan, because we wanted to, we do it actually about every 5 years. But one of the things that we review is the investment return assumption and our asset allocation. So this is just a summary. When we looked at the asset allocation, so think of that as the mix of different kinds of investments. The previous investment mix, the previous policy, I'm on the top table, the previous policy column, the expected return of that mix was 6.6%. So the assumption rate for the pension plan had been at 7.2. So the actuaries are assuming we're going to make 7.2. And we think with the asset mix that we were able to make about 6.6. So we had to close that gap. So we made some tweaks to the asset allocation, which is in the table in the bottom left-hand corner. So we decreased public equities by 1%. We shifted that into private equity. We added 3% to real estate, and we pulled 2% from treasuries and 1% from TIPS, inflation-protected bonds. So in making those changes, the expected return of the plan jumped from 6.6 to 7. Now 7 is still different from the 7.2. So the other thing that we did then from the other direction is we lowered the return assumption in the pension plan from 7.2 to 7.0. Now, when you're discounting back cash flows and you lower your discount rate, you end up with a bigger liability. So in doing this, in adopting this change, and there were mortality changes as well, we're all living longer, by the way, and so it keeps increasing the liability in the pension plan. When we did that, the liability of the plan went up. So that gap of the unfunded piece went up simply because we changed the assumptions that are used to calculate the liability by the actuaries. Next slide. So this is probably too much to go into, but the policy, the board policy establishes a target based on risk for where we think the return assumption should be. And here's what I mean about that. So the red line at the top of the graph represents the assumed return of the pension plan. And you'll notice that over in the far right-hand side, at October 2021, you'll see it went down. That's the dropping from 7.2 to 7 because we did it retroactive to the start of the plan year. The blue line below is called the Ftse pension index, and it has a spread of 2% added to it. So again, this is something we could talk about in depth, but that blue line represents what we believe to be a fair level of risk that we should be taking with the pension relative to where interest rates are in the economy. So relative to what a risk-free rate should be. That blue line is without the spread, by the way. That blue line represents what corporate pension plans have to use. They're required to use by accounting pronouncements of FASB. So here's the interesting thing, at least to me. We talked about at the time with the board, and this was back at the beginning of the year. So, back in January, you can see online where January is, but in the room, there was this huge gap between what we were assuming and what we thought was consistent with a risk appetite for closed plan. And we said at the time that we think these lines will meet, that they'll both have to move. We'll have to keep moving our return assumption down. But we also think at the end of this rate cycle that interest rates are going to start to go back up. And sure enough, that's what we've seen. So this blue line is through, it says April, it's actually through May of this year. So we've had a big increase. So what drove that? Interest rates have gone up. So treasury rates have gone up. So the risk-free investment rate has increased as the Fed has been raising rates. My whole point is there's a methodology now to where our investment risk should be relative to what markets can provide safely. That gap is narrowing, which for a pension plan is a good thing. So even though markets right now are challenging, if we can get through this sort of messy time, and if we end up in a world again where treasury rates are 3 to 4%, well, that makes a huge difference to a pension plan. And frankly, it makes a big difference to retirees because now all of a sudden you can earn risk-free income on your money. So we'll watch that, but this is actually in the policy. So it's a very methodical structure. And the whole point is that we want to, again, lower the risk. We want our risk to be equal to the blue line, not the red line. And over time, we're going to close the gap.
Well,
yeah,
with the increasing apparent, at least temporarily increasing inflation, how does that play into this? Does it or does it not?
So I'll be totally transparent. For our pension plan, inflation is a good thing. It's not a good thing for our retirees, but for the pension plan in terms of solving this gap, because one of the things that inflation brings is higher interest rates. So we get the benefit of the higher interest rates.
But in the meantime, the dollars that you promised are going to be worth less due to inflation. And that's where our side kind of loses on.
Yeah.
Okay.
Yeah. I mean, that's very
No,
true.
that needs to be made explicit.
Yeah. But it's just like I've got investments outside of the defined benefit plan that I'm saving. We have the same issues. Inflation is going to be a challenge, and I'm happy to talk about that because I've certainly got thoughts on it. But let's go to the next slide. So this was really more just for comparative purposes, I guess. So everyone's always kind of wondering what's an appropriate return assumption for a public pension plan. When I started this, 11, 12 years ago, we were at 8%. So we've come down from 8% now to 7% over the past decade. This slide is just showing you from all the sort of really significant public pension plans across the country, it's showing you a distribution of where return assumptions are for public pensions. And then in the table in the lower right-hand side shows the major public pension plans in Missouri. They all happen to be in Jeff City. It just shows where their return assumptions are. So it's just to say that we're in the mix. We're at 7. We'd like to be lower because being lower by definition means you're taking less risk. And with less risk, you get less volatility. But this is a problem that doesn't need to be solved overnight because we're in very good shape financially. When Eric Vogelweide has been on other presentations, when he and I talk about this, we try to make clear that this is a structure that we're putting in place that will work itself out over the next 1 to 2 decades. And we've got plenty of time. And the whole point was the sooner we start this, the better off we're going to be. we're not going to allow this to get into a crisis situation. We have a very manageable challenge before us, and now we have a very effective plan. And again, I've said this, if you're not in the pension world, it wouldn't mean anything, but the policy that the board adopted is one of the most forward sort of best practices of any public pension in the United States. Aside from Indiana really does a fantastic job, and they're in great shape. And we spent a lot of time with them. But again, we're not trying to solve something overnight. We're saying this is going to be around for 100 years. And if we do our thing now, the benefits are going to pay off for decades.
Yeah. If Indiana's sort of managed to bring their return assumption down, did they do that over time too?
They did. It started back in 2012 or 2013. Mitch Daniels was governor at the time, and they said, we want to solve our pension challenge. They didn't get rid of the defined benefit plan. They just took steps to make sure that they were managing the risk appropriately. They said these assumed returns are too high. And they also implemented something that we sort of borrowed from them, the idea that by state law, whatever the state was putting in back then, they fixed it at that level, and they did not let it drop, even when it could have dropped, because they wanted to intentionally be more aggressive toward it. And so they're in a spot now. So 2013, they went down to 675. They had the lowest return assumption of any major pension in the United States. And they've just lowered it to 625. And they're now basically the lowest in the United States now. So it's a good model. And in the state of Indiana, they said the same thing. The state wanted, from a budget perspective, stability in funding, because pensions can be volatile. And what happens with states that have real pension issues is the state gets into a budget issue and they cut the pension contribution. Well, you can't do that. That's why Illinois pensions or New Jersey pensions are so grossly underfunded, because the states just stop making pension payments. The university has never done that. The university has always put in whatever the contribution requirement was. I mean, even back in the financial crisis, we have always made the recommended pension contribution. And again, now we're actually going to be doing more than what's recommended. So next slide. So, you all know this. It's just volatility of investment returns. I had some math that I worked through on this, because on the surface, you look at this and you think from the pension, you're like, well, it doesn't look too bad. It doesn't look like we've had many years that are lost. Without kind of going into it, you'll just have to trust me. But in 2008, and this is, I believe this is calendar year, the plan was down 28%. If we had to make up, like if by the end of the following year, we wanted to make everything up and be on track for where we were supposed to be, the return in 2009 would have had to have been like 61%. Right? It's because you see 21% the following year and you're like, well, that's great. We almost made it all back. Well, no, because for one, your return assumption here was 8%. So your loss is not 28%, it was 36%. Right? And so the hole is bigger, but then the following year, you're not just having to make that up on a smaller base, but you're also assuming you're going to make 8% the following year, which you can't count twice. So the point is, a lot of the issues with public pensions started back in the financial crisis, and many, including ours, have never fully recovered from that because of the math. Again, in 2015, we were about flat, but we were supposed to make like 7 3/4. 2018, we were down about 2%, but again, we were supposed to earn about 7 1/4 or 7.2. So it's volatile and it's hard to manage, and so less risk is better. Next slide. So this is a table, and we can talk about markets now. Happy to answer questions. This is a table of investment returns for our current fiscal year. So this is from July 1, 2021 through May 31st. So just about 3 weeks ago. Probably not surprising to any of you. look at your own separate portfolios. But I'd say, and I think on the next slide, I'll show you some comparisons, but we're actually having a good year. Through May, and I'll talk about June, but through May, the portfolio was actually up 3.5%. We looked at peer data as of March 31st. So this is a peer group, a universe of about 400 pension plans, 350 endowments. Our returns through March 31st were in the top 1 percentile of the peer group. And why? Well, one of the big reasons why is that commodities during that time period were up 41%. We have a big allocation to commodities. I mean, we went intentionally to a higher weight of commodities going into the last year, and it worked out really well. Public equities, as you can see, through May, and first June's been worse, but through May, public equities were down about 14%. US Treasuries were down 4%. Again, why are Treasuries down? Well, because interest rates are going up. Inflation-linked bonds held up and produced a positive return because they can do well on inflation than the private asset classes. But overall, 3.5% through that point in the year, pretty good. Now, June has been, and someone was in one of our conversations, June has been one of the worst months for investments in a long time. The current performance of a bond portfolio, so one of the global bond index is called the Barclays Global Ag. So it's kind of like the bond market of the world. The Barclays Global Ag has performed worse over the last 3 to 4 months than any time in history, in sort of recorded modern history. Interest rates have gone up, which means bonds go down. And then credit spreads, credit risk has also gone up, which means bonds go down. And then all the while that's going on, of course, equities are going down because interest rates. So May and June were very unusual months. And I was listening to a webinar on the way here. Hasn't happened since 1981, where basically every major asset class was down. That just typically does not happen. You usually have diversification in asset classes, but we're in a period right now because of people are responding and reacting to inflation, and that has a ripple effect through asset classes. Even commodities this month are down in June. So where will we end up for the fiscal year? Well, depending on how June closes out in the next couple of days this week, I think equities were down again today. You know, I think we'll end up the fiscal year maybe down 1 to 2%. So kind of going into June again, we were up 3.5. I think that's for sure gone in June. And then the question is whether we're down a point or two or whether we're about 0. Now the pension year is, as many of you know, is September 30th. So we'll see where we are as we get closer to that point. But all things considered, given what's gone in the markets this year, I mean, we're very happy with the investment results. I think on the next slide, so this is just a comparison. We're always asked to compare our performance against sort of an index fund portfolio. So if you had 60% of your money in a global equity index fund and 40% of your money in a global bond fund, the first 11 months of the year, you would have been down 8.1%. We were up 3.5. So not what we need for the pension plan assumed return, but given what's gone on in markets, we've done really well. And we'll see what follows. I don't think at all the volatility is over. I don't think inflation is going away. We haven't thought that from the very beginning. And we think the next couple of years is going to be pretty challenging. So on that happy note, I'm happy to answer any questions about anything for anyone online or here in the room.
Can you hear me?
Yeah.
Hello. My name is
Yes.
Jerry Place. I retired in 2013 want to make 3 points. I'm not very happy with the decision, no more COLAs. I made retirement decisions based on past history. So that's point number 1. Point number 2, my annuity right now is worth 74% of what it was in when I retired. And in 10 more years, assuming I live that long, it'll be about enough to pay for a nice dinner at a 2-star restaurant in Chicago. So that upsets me. Number 3, I have other means. I'll be okay. But there are a lot of retirees that will not be. I just wonder what the board is going to do when we have retirees that are whose pensions have been reduced to 50% of what they were initially, really struggling to get by. So that's my comment.
Yeah, well, those are fair points, and I completely understand your own situation. I understand the impact on other retirees. There's nothing to say in response to that. I think what the board would say is that the plan never had a COLA provision, that prior boards 15 years ago had made decisions in different times to give out ad hoc adjustments. It was never part of the plan. It was never part of what was promised. And when we're facing an actuarial liability of $1 billion, we can't continue to promise more benefits to people. And then again, it gets into other issues of equity with current employees, because COLAs, because they're not a part of the plan, they're not funded. So any COLA adjustment basically would come out of the operating budget, as everything does. And so then you're shifting cost, you're shifting it around. And so I think the position of the board with the policy was that we understand there are issues with inflation everywhere, even among active employees. Our obligation is to honor the commitment that we made to employees, and not anything above that, because we're not in a financial position to do that. So I think both things are true. It's a difficult situation, and we certainly will have retirees that are in a difficult position. But then again, I've heard other people make the same point. Well, we've got other active employees who are also in a difficult position because of inflation and the cost of fuel, and we need to get them salary increases so they can afford food and they can afford gas to come to work. So it's just a matter of prioritizing the commitments that have been made and honoring those. And in addition, then dealing with sort of all the other issues with inflation and active employees. Any other questions? Anything more on the COLA or any? Sure.
On the COLA, I understand that, and some people made choices at the time of retirement to take a lower immediate benefit to get a cost of living adjustment later. So that continues because that was something that was a commitment at the very beginning. Okay, so they're two different things that we're talking about.
And those are choices that employees made at retirement. Right. That's not affected by anything. And employees today can still do the same thing, to take a slightly lower initial payment in exchange for increases. Yeah, it's but inflation is going to be challenging for everyone in society, and everyone is going to be kind of figuring out how to deal with it. We were talking earlier. I was over in the United Kingdom for business, and I just happened to see news article. 25% of the people in the United Kingdom report that they're skipping meals to try to offset the increase in energy costs. I mean, we have increase in energy costs here, but over in Europe, it's a far bigger burden. So it's not just a university problem. It's not just a Missouri problem. It's not just a U.S. problem. It's a global problem. And it's the result of policies over the last 20 years that I think we're at the point where collectively we're going to have to pay for it. And in inflation, I think the government still talks about inflation just going away. it's not just going to go away. It's a cycle and it's going to take a while. And we thought all along that inflation was going to be higher and it was going to last longer. And we think that's still the case. There was an example, just because it's current, I was thinking the Wall Street Journal maybe yesterday, the United Airline Pilots Union had negotiated successfully with United a 14% increase in pay. So they're in a position to negotiate. There's a scarcity of pilots. We've got inflation. So United basically had no choice but to do it. So how is United going to pay for the 14% increase in pay? They're going to raise airfare. So who's going to pay for that? So it's people that buy the tickets. So once this starts, you get this kind of inflationary cycle that's hard to break. Unless the Fed induces a very severe recession, which is one way to tackle it. But you know, the question is, will the Fed have the appetite to induce a severe recession? Because they also have the balance of the mandate of economic growth. So very, very interesting times. I think, the other thing that I observed, you know, for whatever it's worth, is I deal with people that just manage money, and these are the people that go on TV and talk and things like that. And I always ask them when I'm talking to a firm, I'm like, how many of you were managing money back in the 1970s or early 1980s? Of course, the answer is none. Maybe occasionally. So you have this whole current generation, myself included, we've never lived through inflation. We don't know how to relate to it. And so I think in the whole transitory thing, everyone said it's transitory, it's going to go away. I think that was more hope than reality. And I think it's settling in now what inflation looks like. There'll be winners and there'll be losers.
Any guess what a stabilized inflation landscape will look like? 4%?
I think that's a good question. And I would say, you know, the Fed, even at the last Fed meeting, Powell went out of his way. I've said this, I don't understand it. He's insistent that they're going to get it back to 2%. And anyone looking at the numbers are saying that's not going to happen for a long time. So the question will be 3%, 4%.
Historically, it was about 3%.
Yeah.
If you look very long term.
Yeah. So here's the other issue. And I always say, I don't want to sound like a conspiracy theorist, but when you have governments that have amassed massive amounts of debt, there's only two ways out of that. And this has happened through hundreds of years of history. When governments run up debt, they get to the point where it's unsustainable. Either default on the debt, or you deflate your way out of the debt, or really inflate your way out of the debt by devaluing your currency. So I'd argue, you probably might too, that it's actually in the interest of government to have a little bit higher inflation rate because it makes the burden more manageable for the government. So any questions online or any thoughts you wanted to share? Anything is fair?
Curiosity question, Tom. We are at like 79, 82%. What is Indiana at? Since they are really the model, what are they 100% funded?
They're getting close to it.
Are they? Okay.
Yeah. In fact, their policy, and I'm just remembering, their policy said that they had to be something like 110% funded before they would allow the contributions to go down. So. Yeah, no, they're in good shape. And again, maybe if I just close with this thought, our pension plan is in very good shape. If you look at the funding levels of public pensions nationally, regardless of which of the numbers we take, both are in the 80s. They're both very solid. We have a stabilization fund behind it. We've got a commitment from the board to basically de-risk. So we're in good shape, and we will solve this issue. Retirees under no circumstances will be affected. So, thank you for having me here.
Tom, thank you very much.
Thank you.
Close the PowerPoint.